All right, folks, gather round. We've got a lot to discuss today, and trust me, you don't want to miss this. Let's talk about the R word, recession. It's the buzzword on everyone's lips, and for good reason. It's the economic equivalent of a surprise colonoscopy. Nobody wants it, but everyone's nervously wondering if it's coming. The mere mention of it sends shivers down the spine of investors and everyday folks alike. 2025 is shaping up to be a nail-biter. With so many variables at play, it's hard to predict exactly what's going to happen. We've got trade tensions simmering like a forgotten pot on the stove. International relations are more strained than ever. And the impact on global trade could be significant. Consumer confidence is wobblier than a newborn giraffe. People are hesitant to spend, unsure of what the future holds. And the stock market, let's just say it's been on a roller coaster ride, orchestrated by a caffeinated toddler. The volatility is enough to make even the most seasoned investors queasy. So, are we staring down the barrel of a full-blown economic meltdown? The signs are certainly ominous, but it's not all doom and gloom. Or is this just a temporary blip? A chance to catch our breath before the economic engine roars back to life? Some experts believe that this could be a much-needed correction, a reset that will pave the way for future growth. Buckle up, buttercups. We're diving deep into the murky waters of economic forecasting to see if we can separate the fear-mongering from the facts. It's a complex landscape, but with the right information, we can navigate it together. It's enough to make you want to crawl under a weighted blanket with a year's supply of ramen noodles. But don't panic just yet. But before you start building your economic apocalypse bunker, let's take a closer look at what the experts are saying. There are strategies and insights that can help us weather the storm and come out stronger on the other side. When it comes to predicting the economic future, Wall Street analysts are like that friend who's always convinced they can predict the Oscar winners. Sometimes they're eerily accurate. Other times, well, let's just say they're better at picking stocks than picking award shows. The good news? The recession odds makers seem to be easing up on the doom and gloom. Goldman Sachs, those economic soothsayers with fancy suits and even fancier spreadsheets, have dialed back their recession prediction to a slightly less terrifying 35%. Barclays, on the other hand, apparently misplaced their pessimism pants and have dismissed recession risks entirely. Meanwhile, JP Morgan is straddling the fence, putting the probability below 50%. It's like they're playing economic roulette and betting on both black and red, just to be safe. So, who's right? Honestly, your guess is as good as mine. These predictions are about as reliable as a weather forecast in a hurricane. But hey, at least they're not all screaming recession from the rooftops anymore, right? That's gotta count for something. Tariffs. Those pesky little import taxes that seem to pop up whenever countries get into a spat. They're like the economic equivalent of a mosquito bite. Small, irritating, and capable of causing a lot more trouble than you'd expect. Politicians love to wield them like economic weapons, brandishing them in debates and striking deals that often seem more about posturing than practical benefits. They're supposed to protect domestic industries, but they often end up hurting consumers and sparking international trade spats. Imagine going to the store and seeing the price of your favorite gadget skyrocket overnight. Not fun, right? Case in point, the ongoing US-China trade war. It's a saga that has been dragging on for years, with no clear end in sight. It's like watching two toddlers fight over a toy, except the toys are billions of dollars worth of goods, and the tantrums have global economic consequences. The stock markets react like a roller coaster, plunging and soaring with every new development. Investors are left holding their breath, wondering what the next twist in the tale will bring. Remember when the US slapped tariffs on Chinese goods, like washing machines and solar panels? It was supposed to boost American manufacturing, but the reality was far more complicated. Yeah, that didn't exactly go as planned. Prices went up, consumers got grumpy, and the trade deficit actually got worse. Whoopsie daisy. It turns out that the global economy is a bit more interconnected than some policymakers might like to admit. Now, we've got a temporary truce, with both sides agreeing to reduce tariffs for 90 days. It's a fragile peace, held together by the thinnest of threads. It's a step in the right direction, but it's about as reassuring as a temporary ceasefire in a zombie apocalypse. You know it's only a matter of time before the next wave hits. The damage is done. Businesses are jittery, supply chains are disrupted, and consumers are left wondering if they should buy that new TV now or wait until the next trade war erupts. The uncertainty is palpable, and it affects everyone from the factory floor to the boardroom. It's enough to make you want to renounce all material possessions and go live off the grid. Imagine a life free from the whims of international trade policies, where the only tariff you worry about is the one on your morning coffee. But hey, at least we'd save money on tariffs, right? In the end, it's a complex web of cause and effect, and we're all caught in it, whether we like it or not. Trying to decipher the economy's health from current indicators is like trying to read tea leaves after a particularly vigorous stir. The data is often contradictory, and the interpretations can vary wildly depending on who you ask. One day, the numbers suggest a booming economy, and the next, they hint at an impending recession. It's a roller coaster ride that leaves even seasoned economists scratching their heads. The data is murky, the signals are mixed, and everyone's got a different interpretation. Some experts point to strong corporate earnings as a sign of resilience, while others highlight rising debt levels as a cause for concern. It's a tug of war between optimism and pessimism, with no clear winner in sight. On the plus side, the job market is still chugging along, albeit with a few coughs and sputters. We're adding jobs, unemployment is relatively low, and many industries are still hiring. This has provided a cushion for many families, allowing them to maintain their standard of living despite other economic pressures. And wages are slowly starting to inch upward. This gradual increase in paychecks is a welcome relief for workers who have been feeling the pinch of rising living costs. It's not a windfall, but it's a step in the right direction. So far, so good, right? Families are still able to enjoy dinners together, people are shopping, and parks are filled with laughter. It paints a picture of normalcy and stability. But hold on, because here's where things get a little less rosy. Beneath the surface, there are storm clouds gathering. The stock market has been volatile, and financial news is often filled with doom and gloom. GDP growth, that all-important measure of economic activity has been slowing down. This deceleration is a red flag for many economists, as it suggests that the engine of the economy is losing steam. Consumer sentiment, which is basically a fancy way of saying how optimistic people feel about the economy, is in the dumps. When people are worried about the future, they tend to spend less, which can create a vicious cycle of reduced economic activity. And inflation, that pesky beast that eats away at our purchasing power, is lurking in the shadows. Prices for everyday goods and services are creeping up, making it harder for families to make ends meet. It's enough to make you want to hoard cash under your mattress. The uncertainty and fear of losing value in your savings can drive people to take drastic measures. But before you start stuffing your piggy bank with dollar bills, it's important to remember that these economic cycles are just that, cycles. They have ups and downs, and while the current situation may seem dire, it won't last forever. Let's remember that economic data is notoriously fickle. 1 minute it's up, the next minute it's down. The stock market can swing wildly from one day to the next, and what seems like a trend can quickly reverse. The next minute it's down. This unpredictability can be frustrating, but it's also a reminder that nothing is set in stone. It's enough to give anyone economic whiplash. The key is to stay informed, stay flexible, and remember that the economy, like life, is full of ups and downs.